everybody's in the pool. If somebody gets out of the pool, you're going to potentially get a stampede of people getting out of the pool. All they got to do is get out and yell shark, and everybody comes out, right? We've got we've got roughly about 1.2 trillion in margin debt. That's not even to mention the amount of money in levered options, not to mention the amount of money in levered ETFs, which they're trying to bring to markets now, 5x ETFs. So we just have leverage. And then, of course, if I have a leveraged ETF that I bought on margin, I'm even leveraging that up even more. So we have so much leverage in the markets that at some point, if something triggers a sell-off, you're going to get a decent correction. Wake up one morning, look at your account, and your mutual funds are all going to be down $1 or $2. And you're like, what happened? The market's up today and all my mutual funds are down because that's the distribution. In the first 2 weeks, I would expect a little bit of a sell-off in the markets, and doesn't have to happen, but a pullback to the 20-day moving average, something like that, would not be surprising, because in the first 2 weeks of the month, and again, we'll get a lot of headlines, is like, see, the AI trade's over, whatever it is. It's mutual funds distributing all their capital gains and interest and dividends for the year. They have to distribute all that at the end of the year. That tends to occur right in the first 2 weeks of December. So you typically get a bit of pullback in the markets in the first 2 weeks of December. And if you own mutual funds, you're going to see your mutual fund drop in value for a day. And you're gonna wake up one morning, look at your account, and your mutual funds are all gonna be down $1 or $2. And you're like, what happened? The market's up today and all my mutual funds are down, because that's the distribution. In a couple of days, you're either going to get, if you dividend reinvest, you're going to get shares back, or if you don't dividend reinvest, which I encourage you to do, you'll get cash back.
Yeah.
And then you can reinvest that cash
this
somewhere
morning. I looked at my portfolio and saw one of my holdings, wasn't a mutual fund, but it was Barrick, was down like 6-something%. I was like, what's going on with that? It's a big company. It's a big, and then it was the dividend payout.
Exactly. So that's going to happen in a couple of days. It'll all balance itself out. So it'll be fine. So just don't freak out about it, but also just be aware this is going to happen in the first couple of weeks of December. So you normally get a little bit of a pullback, and then that sets you up for the year-end rally, where all the mutual funds, the hedge funds, the pension managers, everybody needs to make sure they have all the right stocks on their books for year-end reporting. Because when that report goes out, they need to make sure that they own the Google, the Apple, the Nvidia, whatever it is. They need to make sure that it's on their books. They may buy it December 29th, but they say, oh yeah, we don't, when you look at our holdings, yeah, we own all these companies. We own all the favorites. So, that's going to happen the last couple of weeks of the month. And that typically is why you get the Santa Claus Rally into the second trading day of January.
Okay.
So that's just kind of the look ahead.
Yeah. And so in a nutshell, it sounds like you were thinking that is the default outcome from your expectation here.
Well, that's the statistical norm.
Yeah.
Does that mean it has to happen that way? Absolutely not.
Absolutely not.
Are there years that didn't happen that way? Absolutely.
Yeah.
But statistically speaking, about 70% of the time, that's the way it works out.
Got it. Meaning, with your positioning there at RIA, you are planning on that more likely than not happening. You're not like battening down the hatches because you're expecting something different.
Correct. Well, that's why we did some buying on Monday. We did some buying in the markets on Monday morning, and we trimmed Google, and we did some buying across the board, rebalanced our dividend equity growth model, to take advantage of some of these cheaper prices, because again, the default expectation is that based on averages, historical norms, et cetera, that markets are likely going to move higher through Thanksgiving and into the end of the year. So we were just positioning ahead of that.
So historically speaking, we might see a dip before the rip. It's a classic buy the rumor setup for the year-end rally. If you want to stay ahead of these critical market moves, make sure to hit that subscribe button right now. Let's see what the technicals say.
Okie doke. All right. So, anything else to say about the S&P here?
Yeah. So this is a couple of things. One, this is also kind of bullish for the markets. So this is the market We've gotten back above the 50, and we had violated the 50 and the 20-day moving average on this correction, came down, touched the 100-day moving average, which is right where the bottom of this correction was. And now I've rallied back, regained the 50 and 20-day. That's bullish. We've turned money flow back positive. That's bullish because money's coming back into the markets. We've triggered a momentum buy signal from below zero, which is also good. That now gives the market some room to run here over the next month, and relative strength is improving after getting decently oversold. So there's a lot of bullish tailwind for the next month behind the markets. Now, again, month, not next year, right? For the next month is what we're talking about. There's just a decent setup now because of this correction. We've had that 4 or 5% correction we just went through provides a very decent backdrop now for a rally for the next month. Now, again, once we get to 2026, I'm probably going to write the Curb Your Enthusiasm article again for next year, because I think we're going to see more, like we saw this year, I think we're going to see more volatility again next year.
Okay. Two things. One, the negative divergence that we saw over the past month or so, is that now over? Because it does seem like all these trends are now moving in the same direction.
Right. So this blue line at the bottom, you'll see is that was the negative divergence in relative strength. So the market was rising as relative strength was declining. And that was why we were being a little bit more cautious in portfolios, because that always precedes a correction of some sort, sometimes bigger, sometimes smaller, but always precedes a correction. So now that we've gotten that break in relative strength, got it oversold, now we can come back up. Now, what would be ideal is if we can get relative strength back above 70 and break that negative divergence. That's, because again, that's, that negative divergence line is going to run to about 65-ish right now. So if we get above that kind of trend line and get RSI back into positive territory, that would be even more supportive for the markets.
Okay. All right. And just because you brought it up, in the words of the great Yogi Berra, predictions are hard, especially about the future.
Exactly.
You wrote Curb Your Enthusiasm at the beginning of 2025.
Right.
And you warned of that it was going to likely be a more volatile year than we had. And you were correct on that. So great. But I think you were sort of setting an expectation that, like, hey, we've had 2 blockbuster year in the markets. We're probably not going to get a third. If we end up rising into the end of the year here, I think we're going to be notably ahead of what your price target that you guys set at the beginning of the year. So my question for you is, there's no criticism here because it's so predictions are hard.
Right.
How surprised are you at how this year is ending versus what you were thinking when you wrote that piece?
So when I wrote that piece, I said expect 8 to 10% for the year, not another 20. We're going to be close to 20 if this market rally. So we're 16% right now for the year. We'll be close to 20% again if this market rallies into the year. We'll be 18%ish, like close enough for jazz, right? That is surprising. I mean, triple back-to-back 20% gain years are not uncommon. I shouldn't say they're not normal, but they happen. We've seen these before. And the more years that we stack up of these outsized gains, the bigger potential that you have for a larger correction at some point in the future.
This is the key takeaway. 3 back-to-back years of 20% gains is incredibly rare. The market is stretching the rubber band as far as it can go. And that usually means a snapback is coming in 2026.
So again, it's just with anything, we're stretching weekly trends and monthly trends to very large extremes. And I think that's something that, we need to at least be cognizant of. Here's a weekly chart of the S&P 500 as an example. So this is the Spider ETF. So this is SPY, a little bit different than the SPX, but it's close enough. Momentum wise, we're very elevated, trying to trigger a little bit of a sell signal here. Last time we had that sell signal trigger was going into basically April of this year. So again, markets can remain overbought for a very long period of time, as we saw kind of all in 2024. Markets can remain very elevated, very overbought for a while. That's the problem with weekly indicators, is that, for instance, a lot of people go, oh, you're triggering a sell signal, I need to get out of the markets. you got to be really careful with that, because you had a whole year where markets were flipping back and forth at very high levels, and markets you had corrections, right? 3-5% corrections, but the market trended higher. So this is not a buy sell signal. It's a bit of a warning signal that we're going to have a bout of higher volatility. So again, I still expect as we get into 2026, earnings estimates are still way too elevated relative to what I think will actually come to fruition. Analysts are very optimistic about earnings growth next year, and particularly they are very optimistic about earnings growth for the small cap, mid cap space. They're expecting 50% earnings growth next year.
Ridiculously optimistic.
Yeah. With an economy that's potentially slowing down next year. So, if inflation continues to fall and the economy slows down, that's not great for profits, because again, you need inflation for profits. That's, the inflation run we had was a big boost for profits, but that's kind of been backtracking a bit here. So again, I'm not going to specifically rewrite the Curb Your Enthusiasm article. I may do a spin-off of it, but it'll be the same idea, which is, hey, I would expect another year. If I'm positioning for this year, I wouldn't go into it blindly. And that was all. And really, the Curb Your Enthusiasm article was really just that. It was, don't go into this year blindly and just be long risk, because we're going to have some volatility this year because of these very overbought conditions. And it took till April, but it showed up, right? Mm-hmm. And I think that's going to be the case this year. We're very extended. We're very overbought on both weekly and monthly bases. That increases the risk for a pickup in volatility and potentially lower returns. And valuations are elevated. We all know that, but valuations are a terrible timing indicator. But it does suggest that you'll have lower returns at some point in the future.
Think about that. Analysts are expecting 50% earnings growth while the economy is slowing down. That disconnect is dangerous. When expectations are this high, even a small miss can trigger significant volatility.
Okay, so let me ask you this, and I'm not trying to be I'm not trying to be intentionally pessimistic here, but over the long run, markets mean revert, right?
Sure.
We've talked about this a lot, right?
Yep.
It is rare to have 3 blockbuster back-to-back-to-back years in the markets. So how concerned does that make you about 2026, just sort of from a math standpoint?
Well, again, mean reversions take a catalyst of some sort.
Sure.
Right. And so we need some type of catalyst to show up in the market. And that could be a credit event.
Right. But as you say, these catalysts are always the bullet you don't see coming. They're
exactly. It could be geopolitical, could be anything. But
sure, we don't know. We don't know what it's going to be. We don't know when it's going to happen. Yep.
Right. But what it does have to have is it has to have the ingredients that makes markets say, oh my gosh, all those forward earnings estimates that we thought we were going to get are no longer valid. It's going to be something much smaller because of this event, whatever it is. That's got to be a thing. That's why generally when we have these geopolitical events that occur, and it's like, oh, this, impact with, Ukraine, or this impact with the Middle East, whatever it is, pick an event. A lot of times those may matter to the markets for just a moment or two, like a day or two is like, oh my gosh, we're so concerned about this. And then markets go, yeah, but that's got nothing to do with earnings. We're back off to chasing stocks. So the thing that creates that larger mean reversion is something that changes that forward outlook dynamic for earnings growth. And I don't know and again, the problem is you never know what that's going to be until it actually occurs.
Right.
But to your point, so having said that, let me share a chart with you. Yeah. So this is a monthly chart.
You're pulling it up. Let me just give an analogy. The way I'm kind of looking at it, which might be wrong, is it's the Jenga tower, right? Mm-hmm. It's, you don't know which block is going to tip over the tower. Mm-hmm. But the longer the game is going on and people are pulling from lower and lower, like at some point, it's going to come, right? And so it doesn't mean it's going to come with the next block. It might not come with the next 10 blocks, but you're like, the longer we go into this game, the more worried I get that this thing's going to topple.
No, I agree. And that's my worry right now. So this is a monthly chart of the S&P 500. Now this goes back to 2005, 2006. This is a terrible chart to time markets with. Absolutely terrible. Do not look at this chart and go, oh my gosh, I need to get out of the markets right now because it's all about to come peeling apart. Don't do that, because you're going to be frustrated if you do that. But what this shows a trend channel that we've been in since 2009. So this big drop off back over here, this is the 2008 financial crisis. Doesn't even really show up anymore, but there it is. That was a 50% correction. Since then, we've been in a very defined bullish trend. Whenever we get to the top of this bullish trend and get very overbought on a relative strength basis, we have a correction back to the bottom line of that trend, which also happens to be the running four-year moving average, which, if I move this line, you can see this orange dashed line. That is the 4-year moving average for that market. So again, that's been kind of the running trend. Right now, we are back up to the top of this trend channel, very overbought on a monthly basis. But again, as we've seen before, this was the peak right before the April correction. We were overbought, had that correction, came back down to the 1-year moving average, bounced off that, then rallied back up.
Lance is showing us the long-term trend channel here. We are hitting the absolute ceiling. While the market can stay irrational, buying at these levels carries much higher risk than it did a year ago.
But here's a good example of what I mean by staying overbought. We kind of first triggered this overbought condition in 2021, and you stayed overbought and the market continued rallying and actually moved above the trend channel for about a year before it finally corrected. And then you had Russia, Ukraine, and the market's corrected back to the 4-year moving average. So my point is, and again, and to answer your question, is that this is why going into next year, I'm a bit more concerned about a pickup in volatility, potentially lower returns, because you just have a very extended and overbought market. Everybody's in the pool. If somebody gets out of the pool, you're going to potentially get a stampede of people getting out of the pool. All they got to do is get out and yell shark, and everybody comes out, right? So that's the risk. I was doing an interview recently with Thomas Thornton from Hedge Fund Telemetry. Sorry, Thomas, I didn't mean to give the wrong name. But he's with Hedge Fund Telemetry, and I was having this conversation with him. And we're using the theater analogy, which is, everybody's in the theater watching the movie. You may want to move closer to the exit, because if something starts to happen, those exits out of the markets get very narrow. And Thomas said, well, it's also, we're in a movie theater with very obese people because everybody's now leveraged. So now that exit gets even smaller because now all these obese people are trying to get out of these doors that are cramming the door space. And it's not politically correct, but it's a good analogy because
I think it's a fair analogy, yeah.
Yeah, because now we've got everybody not only long stocks, we've got roughly about 1.2 trillion in margin debt. That's not even to mention the amount of money in levered options, not to mention the amount of money in levered ETFs, which they're trying to bring to markets now, 5x ETFs. So we just have leverage. And then, of course, if I have a leveraged ETF that I bought on margin, I'm even leveraging that up even more. So we have so much leverage in the markets that at some point, if something triggers a sell-off, you're going to get a decent correction. And a pullback to the 4-year moving average is not uncommon. For the last 15 years, we've tested that 4-year moving average numerous times. So a retest, if you were going to do it today, said, Lance, where's the 4-year moving average? That's at 49.90 right now.
That puts it into perspective. A drop to the 4-year average is a 2,000-point decline. With everyone leveraged and crowded into the same trades, that shark in the pool moment could get ugly very fast.
Wow, that's pretty painful. And I know what you're going to say. I know what you're going to say next.
900.
Yeah, and I know what you're going to say is even if we hit that, that's a 2,000 drop in the S&P, right?
Yeah. You're still in a bull market.
We'd still be in the bullish uptrend.
Yeah. Yeah, it'd just be a correction. It wouldn't be a bear market at all.
Right. Meaning if we did have a bear market, not that you're saying we would, but the pain would be severe because we know it's below 2,000 points from here.
Yeah, exactly.
Yeah. Okay. So
you
answered my question,
let me just reiterate one thing.
Sure.
If you're listening to this video right now, do not go sell your portfolio based on that piece of analysis. It is a terrible, terrible timing analysis. It's something to pay attention to from a risk management perspective.